All right, let's jump right in. We're going to be talking about this incredible book, The Psychology of Money. And its core idea is pretty wild. Being good with money has less to do with how smart you are and way more to do with how you behave.
I mean, think about it. We're always told that finance is this hard science, right? All about data and formulas. But what if that's just wrong? What if that's the very first myth we need to throw out? This book argues that the choices we make with our money are super personal. They're all tangled up in our own life stories, our hidden biases, and these huge forces of luck and risk that we almost never talk about.
And that brings us to the book's first big, kind of mind-blowing idea. When it comes to money, nobody's crazy.
So what does that mean exactly? Well, it means every single one of us makes decisions based on our own little mental map of how the world works. And that map, it's drawn from a teeny tiny, super personal slice of everything that's ever happened. So a choice that seems perfectly logical to you might look absolutely nuts to someone else. And you'd both be right from your own point of view.
Okay, here's a perfect example. Imagine you grew up during a time of crazy high inflation, and you watched your parents' savings basically just evaporate. Now, compare that to someone who only ever saw prices stay stable. You're going to have two totally different views on money, right? One person might hoard physical assets, while the other is totally comfortable with the stock market. And here's the kicker. Neither of them is wrong. They just learned completely different lessons from their own little corner of history.
All right, let's switch gears and bust another huge myth. This idea that financial success is all about how hard you work and how smart you are. The reality, well, it's a whole lot messier than that. See, the book says you just can't understand success without also respecting its two invisible twins, luck and risk. They're basically two sides of the exact same coin. Every single outcome in life, good or bad, is shaped by these forces that are way, way bigger than just our own individual effort. And the story of Bill Gates and his friend Kent Evans is the perfect example. Get this. Gates going to one of the only high schools in the world with a computer back in 1968, that's a 1 in a million stroke of pure luck. His friend Kent, just as brilliant, just as driven, but he got hit by the other side of that coin, a tragic 1 in a million risk. You've got the same talent, the same passion, but the outcomes couldn't be more different. It's kind of sobering when you think about it. Okay, so if luck and risk are these giant, unpredictable forces, what's left for us? What can we actually control? I mean, what's the most reliable way to build wealth when you know some crazy, unexpected thing could happen at any moment? The answer is probably not what you think, and it has zero to do with having the highest IQ. Now take a look at this. This is fascinating. We've got two investors here, Jim Simons and Warren Buffett. Now Simons, the guy is a genius mathematician. His average annual returns were 66%. That's 3 times better than Buffett. But Buffett is way, way wealthier. So what gives? How on earth is that even possible?
The secret weapon? It was time. Buffett started investing when he was just a kid, so his real superpower wasn't getting these insane, flashy returns. It was just surviving. He stayed in the game year after year through all the crashes and booms, long enough for the magic of compounding to do its thing. And that magic is slow, but man, is it powerful.
And get this is the part that blows my mind. Almost all of his wealth, like more than 99% of it, was earned after he turned 50. It just goes to show you that good, steady growth over a really long time creates results that just don't seem possible. It's not about having one great year, it's about having decades of pretty good ones. But you know, this incredible power of compounding can actually lead us down a pretty dangerous path. It creates this impulse, this feeling that the goalpost for enough money should always be moving just a little bit further away. And the book's warning is simple. That is a game you can never, ever win.
I mean, just think about some of the saddest stories in finance. Guys like Rajat Gupta, the CEO of McKinsey, or of course, Bernie Madoff. These guys had it all. Seriously. Money, respect, family, freedom. And they risked every last bit of it and lost it, just because they couldn't stop wanting more.
And there's this incredible little story in the book that is the perfect antidote to that dangerous more instinct. It shows us that enough isn't a number on a spreadsheet. It's a feeling. It's a realization. And it's pretty much the only way to hop off that hamster wheel of always comparing yourself to others.
Okay, so once you start to grasp this idea of enough, it opens the door to another really important idea, the difference between being rich and being wealthy. And trust me, they are not the same thing at all.
Being rich is what you see.
It's loud. It's the fancy car, the designer clothes, the huge house. It's all for show. But wealth is quiet. Wealth is invisible. It's the money you haven't spent. It's the savings and investments that are sitting there, silently, giving you freedom and options. The author used to work as a valet, and he saw this play out every single day. He realized that when a Ferrari pulls up, people don't look at the driver and think, wow, that guy is cool. No way. They look at the car and imagine themselves driving it. The ultimate irony is that the person behind the wheel might be totally broke, having spent their last dollar just to look rich.
So all of this, our personal stories, luck and risk, compounding, the idea of enough, it's all building to one final, really powerful point. It's the answer to the question, what is money actually for? And spoiler, it's not about the stuff.
At the end of the day, the highest form of wealth, the real value of money, isn't buying fancy things. It's buying freedom. It's the ability to wake up in the morning and say, I can do whatever I want today. That level of control over your own time, that's the most valuable thing money can buy. Period.
So let's pull it all together. Being good with money isn't about being a math whiz. It's a soft skill. It's about being humble when you succeed and forgiving yourself when you fail. It's about deciding what enough means to you and not constantly moving the goalposts. It's about saving like crazy, not for a specific purchase, but for the flexibility it gives you. And most of all, it's about realizing that control over your time is the ultimate prize.
And that leaves us with one last question to really think about for ourselves. If you strip away all the stuff, the cars, the houses, the gadgets, what is the one thing money gives you that truly has the most value in your life? Answering that question, that might be the best financial move you ever make.